So, one thing I want to make sure you understand. To close an account, you do the exact opposite of what is in the account. To close an account with a credit balance, you make an equal debit. To close an account with a debit balance, you make an equal credit. Okay? So revenue accounts normally have a credit balance. So you would make a debit to zero it out. Expense accounts normally have a debit balance. So you would credit it to close it out. So you see how that works? So look at your sheet in your book and see what the owner's equity normal balance is, and determine the opposite of the normal balance as to what you would do to close out that account. So, the worksheet that we worked on in Chapter 4, and you can see on page 179 in your book, and there's a short shot of it here on your screen, is a good tool, in fact, the perfect tool, for preparing closing entries. And the reason that is because all temporary account balances are shown together on a single page. So, here you see we've got capital, drawing, service revenue, and our expense accounts. So those are all of the accounts together on one page. So to close the balance of the revenue account, you got to make an entry that reduces the balance of the account to zero. So a revenue account has to be debited for the amount of its credit balance. And here in this service revenue account, you see we had a $4,700 balance. We debited it for $4,700 and brought the balance to zero. And because we debited that balance in the service revenue account, and for every debit there's a credit, we're then going to credit income summary. So we're doing the opposite, right? So with our expense accounts, they normally have a debit balance, so they have to be credited for the amount that they're debited. So you see on this example, rent expense had a balance of $800. On the debit side, we had to credit it for $800. And on the income summary account, we're going to do the opposite thing. So we're going to debit the income summary account. And you see on the last step, we had $4,700 worth of revenue that we credited. Now we add up all these expenses, comes to $2,255. Then we're going to debit it. Okay? So the income summary account is closed to owner's capital. You compute the balance in your income summary account. So the last thing we did, we would take the $4,700 and subtract the $2,255 from it to get the balance, right? And then that balance is going to reflect net income or net loss. And because we had a larger amount of revenue than we had expenses, that means we have a net income. And then we're going to transfer that, if it's a net income, to the credit side of the owner's capital account. So here you see that we subtracted our $2,255 from our $4,700 and got a closing amount of $2,445, and then it's a debit, so we transfer it to the credit side of the capital account, and then we're going to add it to the existing balance of $10,000.